Hello, everyone. We're going to start chapter 6 today. In chapter 6, we will talk about the costing methods to calculate the cost of goods sold and the cost of ending inventory. Um, in chapter 5, we spoke about how to record journal entries that are related to inventory in terms of buying it, getting a discount on it, returning it back, and selling it. It was all journal entries, and the cost of goods sold, the amount of cost of goods sold was always given to you. In chapter 6, we will talk about how to calculate that cost of goods sold. Now, someone might think, well, that's easy. We can just find out what was the cost per unit for each one of those units that we sold out and just multiply it by the quantity that we sold out. Yeah, that is the case if all the units that you purchased cost you the same thing over time. But that's not always the case. You might have different costs from time to time, right? And in your inventory, you might have a collection. So the same product, that same product, you might have thousands of units of that, and they're all identical, but probably you get those 1,000 units in different shipments, and then every time you had to pay different cost for those units. So when you sell them and then you go ahead and record a journal entry for cost of goods sold, you need to decide which cost you need to consider when you record the cost of goods sold. Do I consider the cost of the first shipment or the second or the third? Because they have different costing. So if you think that, well, we can find out the cost of that actual unit and then find out where that unit came from shipment A or B or C, and then based on that, we can use the cost for that. But the thing is, it's not always easy to do that. What if that was a small product, like a food can or chocolate, and you get them all mixed up, and then usually companies or retail stores, when they have them on display in the store, they're probably going to grab those units from the warehouse, and the warehouse will have all those different shipments mixed up together. So it's really hard to tell sometimes, where did you grab those pieces from? Is it actually coming from the first shipment or second shipment or third shipment? Because you got them from the warehouse, they're all mixed up. So when you record the journal entry, it's really hard to go back and trace the exact cost of that unit, because all of them, they look the same. So what we can do is we will have three different methods of calculation. You might say, well, we will use the cost of the old shipment first, and we just go in order. We start with the older one. We use the cost of those units. Once we sell all of them on the papers, I mean, not the actual units. Everything we're gonna talk about today is numbers on papers. We're not gonna talk about the actual physical units that we will have in store. Those the physical units, you might sell them in order, in a specific order, but you can use a cost of a different shipment for your cost of goods sold. So you can sell a unit from shipment A, and when you record the cost of goods sold for that unit, you can use a cost from a shipment B, all right? Which is fine, which is acceptable. It's fine. Doesn't have to be the cost of that same shipment. So three different methods of calculation. The first one is called FIFO. The second one is called LIFO, and the third one is weighted average. And there's a fourth method, which is also which is the specific identification method, but we will only talk about the first three. FIFO means first in, first out. It means the cost of the first shipment will be used for the cost of goods sold. So whatever we sell, we start in order. We sell in order. Okay. Once we finish using the cost of the first shipment, then we start using the cost of the second shipment, and so on. Remember, we're just talking about numbers. We're not talking about the physical units. You can still sell the physical units in order. Either you decided to use the costs in order as well, or reverse, which is going to be the LIFO method. So let's start talking about FIFO. I have an example here, and we do have a table that shows quantity purchased at a different days during a specific month, the month of August. We got August 1st, 5th, 15th, 26th, and 31st. And we can see from the table that on August 1st, the first day of the month, we started with 2 units on hand. If you look all the way on the right side in that column that says quantity on hand, you will see that we had 2 units available. Okay. And then on August 5th, we purchased 4 more units. So we had 2 and we purchased 4. So the total as of August 5th is 6 units on hand. That's what we have available. And then those 4 units that we purchased, each one of those units costed us $360. And I forgot to mention that the first 2 units that we had on hand, the cost per unit was $350. So you can see that there's a difference in the cost. The first one was $350, the second one was $360. Okay? And that's because the supplier is increasing the prices from time to time. And most of the time the prices will go up, by the way. Very seldom the prices will go down. And then in August 15, we sold out 4 units. So remember, we had 6 on hand, we sold 4. So as of August 15, after selling those 4, we went back to 2 units. 2 units on hand, which is the ending inventory as of August 15. And then August 26, we purchased 12 units. So that makes it 14 on hand. And then those 12 units costed us $380 each, which is higher than the previous purchase. And then on August 31st, we sold 10 units. So 14 minus 10, we got 4 units on hand at the end of the period. So on the right side, you will see that I have 2 columns. One of them is the cost of goods sold, and then the cost of ending inventory. So the units that we sold out, we're going to find out what the cost for those are. And the ending inventory we had on hand, we need to find the cost of that inventory, ending inventory. Okay? And so we're going to start with the FIFO method, the first in, first out. That means if we go back to the table and look at August 15, you will see that we sold out 4 units. Okay, so that's the first thing we need to calculate. The cost of those 4 units that we sold on August 14. So if I'm going to use FIFO, first in, first out, that means I have to go in order. I will start using the cost of the older shipments first, and so on. We go in order. So let's look at what is the cost of the first inventory, the older inventory that we have. Look at August 1st. We had 2 units. Each one was $350. Okay? And then, again, we sold 4 units on August 15th. So we're going to take those 2 units that we had on August 1st. But 2 units is not enough. I still need 2 more units to make them 4. So we will look at the next one, which is the purchase that we had on August 5th. We purchased 4 units, and the cost for each one of those was $360. All my calculations for cost of goods sold down here, cost of goods sold, and then I will say quantity, and then unit cost, and then the total cost. So I will do the calculation here, and then when I get the total amounts, I will shift them to the column that I have on top. Okay, so the cost of goods sold, the first one we will look at, as I mentioned earlier, is August. Sorry, this is August, AUG. 15. The first one is August 15. Okay, so I will put the dates over here. The quantity we sold out were 4 units, and then the unit cost is, I have to break the 4 units, I have to break it down into 2 plus 2, because every couple of units has a different cost. Again, we're gonna start with the first 2 units we had on hand. Each one was 350, so I'm gonna multiply 2 by 350, and then 2 multiplied by 360, which is 2 of the units that we purchased on August 5th. Okay, remember, I'm going in order. So the total cost will be $1,420, and that would be my cost of goods sold on August 15. So I will just make an arrow, and I will just mention 14 and 20 for August 15. That would be my cost of goods sold. Okay, and then what is the cost of ending inventory? So I will do that here. Okay. So again, that will be August 15th. And then I will have quantity, unit cost, and then the total cost. Okay. So if I sold out 4 units, and then just before we sell those 4 units, we used to have 6 units available. If you go back to August 5th, we used to have 6 units, and that was right before we sell the 4 units. So now that I sold 4, my leftover quantity, or the quantity on hand, is 2 units. Now, what is the cost of those 2 units? Well, let's go back to cost of goods sold. If the first 2 units that were costing me $350 each, if those are already sold out, then I don't have those units anymore. So we cannot use the $350 anymore because this is gone. And then from the purchase we did on August 5th, we purchased 4 units. We sold 2 of them. So we still have two units left over for the cost of $360 each. Okay. So I will say that the unit cost is $360 for those 2 units that I have left over. Okay. And then multiply the 360 by 2, that will be $720. Okay. So on August 5th, my cost of ending inventory is $720. Okay. So that gives you an idea on how FIFO works. We start from the old stock first, and then we move forward, and then the leftover. So basically the younger inventory will be the ending inventory, because the older ones will be sold out. Okay. All right. Let's continue. So what is my next sale? On August 31st, we had our next sale. So 31st. All right. And well, before we go to the 31st, let's look at the ending inventory on August 26th. We did not have any sale on the August 26th. We just had a purchase for 12 units. And each one of those 12 units costed us $380. Okay. So I will say that on the 26th we still have those 2 units that we had them on August 15. We still had them all the way until August 26th because we did not sell them yet. So I will say that I have 2 units as well as 12 units. I'm not going to add them. I'm just going to keep them separate. Okay, let me just draw a line here. I'm going to keep them separate because the cost for each one of them is different. The 2 units is 360 each, and then the 12 units, go back to your table, we purchased each one of them for $380. Okay, so multiply the quantity by the unit cost, and then add them up. So at the end of August 26, your total of cost of ending inventory will be it'll be 5,280. Okay, so over here, and that's for the 14 units that I have available on 26. Okay, 2 plus 12 is 14, but we had to calculate each one of them separate, the two units separate and the 12 units separate, to come up with 5,280. Okay, so 5,280. Actually, that arrow has to go all the way here because we do not have cost of goods sold on that particular day. Okay. All right, let's go back to August. Let's move forward and look at August 31st. We have a sale on that day. We sold out 10 units. Now, to find out the cost of goods sold for them, we need to look at our ending inventory just before we sold those 10 units. So let's go back to our last line we have under the ending inventory, and we need to look at it in details. We need to have the details about that. So we have ending inventory that it costed us 5,280, but that's not enough information to find out my cost of goods sold. I need to find out the breakdown for the 5,280. Where did that number come from? So we go back, look at the quantity. We have 2 units, 360 each, and 12, 380. That's the information I will need to figure out my cost of goods sold for the sale I did right after that day. So if it is FIFO, then I have to start with the old stock first. Here's my available stock: 2 units for 360 each and 12 for 380. Which one is older? The 2 units are older than the 12 units, so we have to start with the 2 units first. Okay, we sold 10 units, so I'm gonna take those 2. So under the unit cost, I will say 2 units for 360, and then 2 is not enough. I still have to get 8 more units because the total is 10. Okay, so now we will go to the next line, or we can say the next layer of inventory. We have 12 units. We're gonna take 8 out of those 12, and that will be part of my units that I sold out. Each one of those 12 is $380. So you multiply 380 by the 8 units. So the total is 10, but 2 units were costing us different than what the 8 units costed us. Okay, and then you just multiply and find out what was your cost of goods sold, and that will be 3,760. Okay, so we'll go back to the table above. I would say those 10 units, and then here, let me just expand that out a little bit so that makes it clear. The 10 units costed us 3,760. Well, now that we sold 10 out of those 14 that we used to have right before we sold those 10 units, now let's find out what is the cost of the ending inventory, or the leftover inventory after we sold the 10. So on August 31st, let me just draw a line here, and then I guess line there. How many units do we still have? Well, we used to have 14 minus 10. That will be 4 units left over. And then if you go look back at the table here, you will see that we have 4 units. And all those 4 units, they are from the purchase that we did on August 26. Remember, we took 8 out of those 12 units, so we still have 4 units left over. Okay, So all of those 4 units, all of them costed us 380 each. Okay, so the cost of ending inventory, you multiply 380 by 4, and that would be 1,520. Okay, so all right, so so those 4 units, 1,520. Okay, that's how we do FIFO method, and what I did not mention at the beginning is that we can also use perpetual inventory system as well as periodic inventory system. Companies will have to choose between those two, and it works a little bit different between them, but not with the FIFO method. With FIFO, it's the same. Either you do perpetual or periodic. But when you do LIFO and weighted average, then they will look different. And I will, in the next videos, we will explain the difference between them. Like we will have an example using perpetual and a different example for periodic.